Ladies, AJ Brown here, your financial coach, your business coach, and your life coach, if you want me to be. Today's message is about how to apply for a mortgage and a purchase or refinance mortgage and never ever get denied. Can it be done? Absolutely. When I underwrote and also, before underwriting mortgages, I was a loan officer. My deals never got turned down. And the reason being, I knew what I was doing. I knew how to check for problems before they were problems, before the underwriter actually even had taken a look at the file. But what I want to do today is teach you guys how to take care of your business before you try to go get a grant to buy a house or qualify for a grant to buy a house or go directly with your down payment to a Bank of America, Wells Fargo, or any mortgage brokerage business in America and get approved straight through, no problems, no issues. So also, if you have questions, you can post them in the comments area. I will have someone read out the questions to me to let me know that they're there, because I can't see them being filmed. So let's start this way. When you want to apply for a mortgage, first of all, we all understand the foundation of America's underwriting policies is credit. So we already know with the mortgage not companies, but those that are backing the mortgages, such as we got Fannie Mae here, okay? That's a government agency. We got Ginnie Mae, okay? We got Freddie Mac, okay? We also have two more agencies. One is, and it's very common, I'm going to talk to you a little bit about them and what we used to do with them, FHA. Okay? Hopefully you guys can see this writing. My marker's small. And then we have VA for veterans. I'm going to tell you the difference between them all, and I'm going to share with you what you should do to keep from being declined or having a delay in you getting that home of your dreams. So now, conforming financing, which means basically regular finance. Okay, it's going to fall in the areas of the Fannie Mae, Ginnie Mae, Freddie Mac loans. Now, these are Ginnie Mae and Freddie Mac loans are not really that common to be used. Fannie Mae is. Fannie Mae usually, when it's underwritten, they want you to have a really high credit score, depending on the commercial lender you're going through. Now, the commercial lender will have their own criteria, but when it comes to that they underwrite the package, but also Fannie Mae, Ginnie Mae, Freddie Mac, FHA, and VA also have their own criteria. That's how come sometimes you may have had a friend or a family member or a business partner said, man, I went and qualified and I was approved, and something happened when I went to go get financing. The bank told me I was approved, but then the financing fell out. Well, that's because Fannie Mae, Ginnie Mae, Freddie Mac, FHA, and VA, these are for veterans. Okay, if you have your DD 214s, you can qualify for a VA finance, and I'll tell you what that is in a minute. But these guys here have their own criteria, and if one thing is off, the whole deal is dead. So what I want to teach you today is how to make your end stand up strong, so that way you are the overcompensating factor when it comes to financing you for your home. So now, let's go ahead and get rid of these boys. I'll start with what's going on. Now, we all know that we had a mortgage meltdown in 2008. Basically, we used to have lending criteria called subprime mortgages. Okay? I'll just write subprime. Now, subprime was was one of the camels that broke one of the straws that broke the camel back in the day. Basically, if you're someone who couldn't qualify for Fannie Mae and those other two, or FHA or VA loan, this is where you went. If you don't own a home but you had a car and you had bad credit, They never gave you prime financing. They gave you something called subprime auto financing. Subprime is for folks who do not meet a certain credit score or a certain credit criteria. All right? They didn't want to all the way tell you no. So what they did was they created this beast right here, and it ate all the stuff that all the guys that what we call A paper, who didn't want to give you any money at the low interest rate and the light down payments. So usually these boys here, you had a I'm going back to talking about houses now. We went anywhere from 5 points or 5% to 10% down. And the thing is that changed as time had gone on after a few years, because now with the subprime animal, it went from 5 to 10% down to 0% down. So we had people who didn't understand credit and they didn't know how to maintain their word. With low credit scores, they didn't know how to maintain credit. Your credit is your word. If you watch my videos, you know that I always say that the only thing a man or a woman has in this world is their word or what they say they're going to do. So if you say you're going to do something on a certain day and you miss a day or you're late by an hour or something, you broke your word, so they break you. What? So anyway, this is what happened. Now, even though they gave you a no money down deal, they still hit you high with interest rates. I think the best I saw the rates get was like 6%. All right, but when they did subprime 100% financing, it was something called 80-20. Okay, the first note was usually if you got I'm not going to go into how the wholesale work right now. I'll do that for another day, or maybe I can sneak it in. The first note, okay, we get 2 notes. This equals 100% financing, right? So the first note usually be anywhere from 6 to, I've seen as high as 9%, and the second note, which was a smaller amount, example, if it was $100,000, 80,000 would be at 6 to 9% in between there, whatever your broker that you work with offered you. And the second note, usually, if you had good credit and you did an 80-20, the second note would probably be like 7%. But if you were under subprime, you were 9 to 12%. 9 being really good. Okay? So, that's how that worked. And that was probably the beginning to the end for us all, because when they did that, you got a lot of people in there who did not understand how to pay their bills. So this program is gone. There is no more subprime for home purchasing. That's gone. The new subprime market, subprime lender now is FHA. That's under federal guidelines, okay? Between me and you and the news and the rest of the world, the government actually owns all of the financing deals, which I don't think they should, but they do. But FHA, their rules usually go. I hope you guys can hear me. Can you guys hear me? Anybody on there can hear me? Can you guys hear me? Okay. I hope so. My earpiece may be dying. If you say anything, let me know. They're saying they can hear me. Am I saying anything? Okay. Just let me know I'm speaking. I don't want anybody else speaking. All right. So anyway, we have FHA's guidelines now. Before they used to be 3% down. Thank you very much for that response. Before they used to be 3% down. Now FHA is anywhere from 3.5% to 5% down, depending on who you go to. And what does that mean? 3.5% times whatever the sales price of the house is. 5% times whatever the sales price of the house is. So if it's $100,000 sales price, we're talking about $3,500 down to $5,000 down. So if you're in this range financially for down payment, you're good. Now, what they want to see in underwriting, they want to see someone with a minimum credit score of 620. If you do not have a 620 middle credit score, You may want to work on that before you waste your time, energy, and efforts looking for a house. Don't put the cart before the horse. You want to go ahead and get not just pre-qualified, because anybody can do that. You want to get pre-approved. Pre-approved is more stronger than someone getting pre-qualified. You know, if a baby understands algebra, they can pre-qualify you and give you a piece of paper and say, hey, you're pre-qualified. Okay? But today's realtors, they don't want to deal with people who are pre-qualified. They want people who are pre-approved. Pre-approved means you've gone through the steps I'm about to share with you, and that a lender has said yes to you. And the only thing they want you to do at that point is find a property. And once you find the property, then you got to go through the property has to qualify. So there's two things qualifying on a loan. Okay? It's going to be you with your credit and your money. It's going to be the property itself. All right? So let's move on. We already know the 620 middle credit score. If you do not have that, do not waste your time. If you don't know what kind of credit score you have, I'm going to write down this website. I'm going to do this. www.creditchecktotal.com. Now, the reason why I like using this particular website is because, for the simple fact that when I use it in credit repair, it lays out just like a banker's credit pull report. When I pull the report for someone's credit at my mortgage office or auto loan, it's a hard pull, which means you're going to get a ding to your credit score. It's to your credit inquiry area. Okay, and what does that mean? What that means in layman's terms is you're going to start showing that you are pulling your credit to acquire credit. Excuse me, you're pulling your credit report to acquire credit, and that usually drops points. Okay. What is what you must do and who you must be before you go to a lender for a car or for a house to pull your credit. If you feel that you're not sure about your credit, go to this website. Costs $1. It is a credit monitoring service, and what does that simply means is that when you go to this credit company, credit reporting company, they're going to charge you $1. That's the initial fee. If you do not want to keep the credit monitoring service, you would need to go ahead and cancel it within a certain amount of days, probably 3 to 5 business days, so that you won't incur any other charges. Now, if you're someone who has less than a 620 credit score, and you find out for sure after you've gone to this website, paid your $1, what have you, you may want to keep the monitoring service and then call me back and register with me to have your credit repaired or restored or even boosted. I'll do that for you, no problem. Okay? So I'll help you with your credit repair and restoration. There's a difference. Credit repair erases all of that negative items. Credit restoration explains it. Quick story. I hope you guys got this. There's a question?
Yes. Ms. Patterson asks, what about Credit Karma and are they accurate? Ms. Patterson.
Ms. Patterson, thank you so much. That's an awesome question. Thank you for paying attention and being bold enough to say something. Those companies, they are a credit monitoring service as well. The most accurate agency that I've found besides us going to our hard pull source, and even they have mistakes too, has been creditchecktotal.com. Credit Karma, they're okay, but I found them to be a little bit inaccurate because you got to remember their whole, all these businesses' whole business model really is to sell credit monitoring services. If repairing your credit is paramount, and definitely if you want to work with me, and I'd love to work with you or anyone that's in need, because I love to help my community best as I can. This is the company of my choice because of the layout of the reports and how they look. They look just like my hard pull credit reports. People ask me all the time, why do I recommend using this company? That's the plain simple fact that the way how it lays out and the accuracy of of the information that we get or the client gets from them. Because I don't pull your report when you go here. You do it yourself, and then you forward the report over to me, and we set up a time and we go over what the report says, and then I, at that time, will explain to you what you would need to do and how I could help. So hopefully that explains everything. Now, I hope everyone wrote this down, www.crypto.com. So, well, no, right now, without payment, they're chasing at 5%. I'm sorry, it's 3.5%. 5% is with Fannie Mae. 5% or greater is with Fannie Mae, Ginnie Mae, and Freddie Mac. The veteran one, this is one of the benefits, I guess, for being a veteran. I mean, I appreciate you all service. I mean, I really do. I love you guys. I got family members in the service. When I talk about the VA loans, I'm of the opinion that I'm a bit disappointed in my so-called representing government. I think they should do even better than what I'm about to tell you about for our veterans that have gone over their fault, came back whole, and even the ones that came back and weren't whole. I think they should do better than what this is. Now, we already understand the down payment for FHA loans. 5% is for Fannie Mae, Freddie Mac, Ginnie Mae, or greater. And you can put down more than 3.5% with FHA. I'm sorry, I don't want you. That's the minimum. Let me clear that up. That's the minimum you can put down. You can put down 50% if you want. Okay. Anyway, closing costs with the Fannie Mae, Ginnie Mae, Freddie Mac, usually around 6%, 6%. VA, they for being a serviceman or servicewoman in our military, they get a no money down payment with and no closing costs feature. No closing costs. With the no closing costs, I'm going to say that they roll all that stuff into the loan anyway. They figure a way to do it. Okay, no down payment is there, which means you're financing the whole nut. Anytime you do no down payment on anything, it's the worst deal you can ever do. Let me give you an idea of why I say that. I'm going to move on. Okay, if you have questions, please don't be afraid to ask me. I'm here today. I'll be going out looking at some real estate purchases. I'm a real estate investor as well as a lender. So let me know if you have questions. Now, why I say that no money down deals are not great, because let's say $1,000 for a property, okay, and you paid it down, because the way loans go in the beginning of a loan, I'll teach this in another video. In the beginning of a loan, most of the money you're going to pay is interest. For some of the folks that have financed the house, they'll know what this means. If you haven't financed the house, but you financed the car, this may seem familiar. Your purchase price may be $100K, and then that's in one box. The other box will tell you how many payments, right? Then the last box will tell you all of your interest payments, right? And that box usually have a number, like if it's $100,000 and you finance, let's say, a house over 30 years, that $100,000 may look like, depending on your interest rate, may look like $700K or something ridiculous like that. And you're like, well, what the heck is that? Well, you're paying, what that is that you're paying the principal plus whatever the interest that they're charging over 30 years. So yeah, when people ask me when I'm doing their finances, and they're saying, Coach, I know I made a lot of money. Where is my money? That's where the hell your money is at. In interest payments. And the same thing with a car. It might not be $100,000. Some of my balls out there paying $100,000 for cars and financing them. But for the regular folk, you may be financing $15,000, $20,000, and those numbers, you may be at $20,000, but over here may say $50,000 or $35,000. That's the interest. That's the interest amount plus the interest and the amount of payments put together. That's what that is. But if you get with us, me and my team, I can show you how to cut that in half. and save yourself in time and payments. And while you save yourself time and payments, I can also show you guys, you're paying off the house faster. Now you got disposable income that you can use to put away in the right type of investment account, so you can find 7, 10, 20% returns a year. So so the rule of 72 will apply to your savings. But we'll talk about that another day. Now moving on. Here's what we're all waiting for, right? Ready to go? Like I said, ready to go? We gotta take notes. We're getting notes here. We gotta take notes. Ready to go? Say you're ready to go. All right. Just do it by thumbs up or say okay. All right. Good to go. All right, here we go. Now, here's what we've been waiting for, right? When I'm financing a loan, we got 2 criteria. Okay? We're going to call this, the first one we're going to call, and this applies to people who want to purchase a house and also people who are refinancing. You know this and understand this because I'll talk to you about your credit. You know what scores you need minimum. That's part of the battle. The other part of the battle for you is going to be the finances, being able to show your ability to repay. So, we got front end ratio, and we have back end ratio. All right? Now, because the special finance option is gone, because at one time it used to be 50% front end and back end. Okay, that game is gone. What that means, that 50% of your income will go to your principal, interest, taxes, and insurance payment, PITI. That plus any outstanding revolving, be it in revolving debt or installment debt. Revolving debt, okay, just so that you know, I'll write it down. Revolving debt will include things like credit cards, okay, anything that's not secured and is financed like this, okay. If it's only secured by your signature, that's usually revolving debt. Installment debts are things like car loan, mortgage. Don't make fun of my handwriting. I'm sensitive about that. Mortgage. If you like to go finance furniture, that's an installment. That's an installment type of debt. Okay? Any questions? Let me know. Revolving debt is usually unsecured debt, such as credit cards. Installment debt, car loan, mortgages, furniture financing, things like that. Alright? I'm going to erase that. We're going to get on. Moving on. I want to move quickly here. Now, front end back end ratio. This is the first thing as a loan officer. Well, the loan officers they have today sitting in the banks, they don't know nothing besides hello, welcome, and all that stuff. A mortgage broker or a loan officer outside of the bank knows all these rules and regulations because that's how they. Why are you shaking my camera? That's how they earn their money on commission. That's how I earn my money on commission. So because I'm a commission-based individual or a self-employed person, I have to know the rules. So, back in ratio. Please do not call. Because I'm not going to stop while we're recording. We're okay? All right, front and back in ratio. When we do anything, usually we want to be 29% of your income. And I'll give you the numbers in a second. Usually with FHA, we want to be 41% back in. I'll explain what all this means. Now, let's say you're somebody that makes, pull your calculator up. Let's say you're somebody that makes $3,000 a month. That's your income. $3,000 a month. Give me 3,000 times 29%. We're going to calculate here's the formula for calculating your front-end ratios. 29%. You got, some of you guys should know how to express it as a decimal point. So do that. 29% times 3,000. That's going to equal $700. What that means is that's what your principal and interest, tax insurance payment maximum can be. That's the most you can qualify for a house. Okay? That's the most you can qualify for a house. Payment monthly. And that includes principal, interest, taxes, that's real estate taxes, and insurance. That's what this would be. That's what front-end ratio represents. Back-end ratio represents your front-end ratio plus any other bills that you have. Bills meaning a car note, furniture payments, child support, so on and so forth. Payments that are not calculated in your back-end ratio, your FP&L bill, cable bill, light bill, water bill, things like that. Your utilities, all that kind of stuff, that stuff is not calculated in your back-end. Excuse me. This is what's calculated in back-end payment, sorry. The things I was mentioning earlier are the things that are not calculated, such as your utilities, cell phone bill, and things like that. So you have to be careful when you're purchasing a home, because most brokers or loan officers may not care about you as much as I do. They're not going to tell you the truth about, okay, you make $3,000 a month, but let's see what happens. Let's do a scenario. If you have questions, you can stop and ask me. It's okay. I'm going to shut this down in a moment. Let's say your car note is $400. Furniture you finance is, I don't know. I've never financed furniture, so I'm just guessing. I don't know how I go, because I would never finance it. Let's say you pay $300 a month for that. And let's say you have to pay $300 a month, when we know it's probably more than that for people, unfortunately. More for child support. Now, let's add all this up. $870, $400 plus $400 plus $300 plus another $300. What's our total? We're looking at $1,870, $1,870. That's front end and back end. Now, what you want to do is divide 3,000 by 1,870, and it'll come up with a decimal point. Or it should. Another one. Go the other way. 1,870 divided by 3,000. I've been a little bit spoiled. I've been using computers for a long time, so excuse me. I got to check to the calculator. Now, when you divide this 1,870 divided by 3,000, I hope some of you folks are out there listening and you following me. I hope so. We're looking at this is what we're looking at. 62% for the total back-end ratio. If you guys are still out there and if you're listening and watching, question. Will this person with this debt right here get approved for a mortgage? Now, let me say it like this. This person has a 780 credit score. And they got a 62% back-end ratio. Will they get approved for a mortgage? you shaking your head? Are they responding? Oh. Anybody know? Well, I can tell you. If you don't know, I'll give you the answer. The answer is no. Heck no. As an underwriter, if I ever had a loan officer send me a deal like this, I'd make sure I get his name and number and block him on my list. I would not fund any of the deals because there's no computer automation that's going to generate an approval for 62%. And a human underwriter dang sure ain't going to do it because a human underwriter's job is on the line every time they sign their name to funding documents. So that person won't work because they're spending out 21% too much money for them to get approved for a mortgage loan, even though they got a 780 credit score. So it won't happen. So what we got to do, ladies and gentlemen, okay? We already know what PITI is, I hope. If not, rewind the video. The trick, besides having a 620 credit score or better, 620 being it's like being a redhead stepchild with freckles on their face, but maybe not all the freckles, maybe 2 freckles. They'll still say yes to you at 620, depending on some issues. But we got to remember, we want to remain at. Sometimes they may go up on this. They might go as high as 31 or 2% on a mortgage. Might not. And just so that you know, Fannie Mae, Ginnie Mae and Freddie Mac, they're a little bit lower than this. So that means you got to have some money and some really good credit to do a Fannie Mae loan. If not, you'll be FHA or VA. If you're a veteran, you're a DD-214. And you want to remember, even if the lender said, hey, you know what, it's fine, I'll let you go up to 50% on your back and your ratio. Be careful of that. They had this put in place for a reason. And even if we go up 50%, the lender says he'll take you up 50%, that don't mean you have to go. Don't ever want something so bad where you'll put yourself in a financial risk. Okay? This is the key. 29%, you multiply that times your income by the month. 41%, you multiply that times your income. That's the most that they want to see you spending out. And that's including that payment. So this is added to that. Now, if you don't have any other questions, I'm going to move on to something else. I'm going to end the video momentarily. I'm going to go ahead and move on to something else. I know you guys got some great nuggets today. If you're someone who wants to buy a house, don't understand how the process goes, and you're afraid of it, or you work with somebody and it didn't work out, or you're just somebody who wants to qualify for a mortgage trade, you don't have time for the games, all the ripping and the running. Well, get with me. I'll help you. I'll get you straightened out. I'll even get you the funding if you need that. Not a problem. If you need the credit restoration, credit education, I will help you. My team will help you. We're here to do this. I do this all day. Been doing this for 16 years. This is what I do. Okay? So you need help with that, I got you on that. Just get in contact with me. You can inbox me, or you can reach out to me on Facebook, on the Front Street, or one of my business pages. It's fine. You can leave a comment in the comment section, and I'll help you with that. If you have no other questions about front end and back end ratio and credit scoring, I think I've given you some really good nuggets for today, and I have other work I got to get to. This other work might be something that'll help you. If you know somebody out there that's losing their house through foreclosure, tell them to reach out to me. Give them my information. Don't be afraid. I'm here to help. With foreclosures, is either with how that works, you got to have 3 things. One, you got to know how to negotiate with the lenders and all that hoopla they got going on. 2, you got to have the experience. And 3, you got to have the money. If you don't have any of those, all 3 of those, it'll put you in a vicious cycle. Reach to me, and we'll talk about options to help you remain in your home. Or if you don't feel like you want to be there any longer, it's okay. We can make arrangements for you to go somewhere else, and I'll take over your home payments and all the things that's wrong with it, whatever, and I'll get it off your credit, get it off your back, off your neck. So you can reach out to me on Facebook or call me at 954-687-1079, and hopefully you got some great information today. Because I know your lender didn't tell you this. I know your loan officer didn't tell you this, but I'm always here to tell you the truth. I was not somebody that's supposed to be out here selling, but I'll do it if that's what you need me to do. But that's not what I'm here to do. I'm here to educate and get my people, whoever they may be, to the area they want to be with ease. More, without having all the hoopla of trouble. We got enough trouble already. So I want to add to some of the easiness of the ways that folks may want to go through to live their life and to get the things that they feel like they deserve. So with that, I just want to say thank you for tuning in. Thank you for the opportunity of allowing me to teach you guys what I know and to be able to be here in the community to help nationwide. So if nothing else, I'm going to go ahead and hit that finish button. Oh, there's a question. Go ahead.
By Ms. Patterson again.
Yes, ma'am.
What she said was, I was pre-approved by the bank, but for a very low amount. I was told it was because I have a car loan. If I paid off my car, would it help me get approved for a higher loan?
Yes, but I don't know how much your payment is, and all those different things. But the one good thing I have to tell you, I don't know who you were trying to get approved with, but it shouldn't really matter. If you're in the last 10 months of paying your car note, you should be able to. They have the option of taking that payment out, so they can say you could qualify for more. But with that, I say be careful, because now if something happens, you've committed yourself to higher money that you really don't have. And like I said, there's a reason why initially, we got that back-end ratio there. Even if they tell you you can go to 50% with the way how the economy is going, and if you have only one job and you're not a business owner and you're not taking advantage of tax breaks, you're not really maximizing the opportunity here in America, I would be very careful with trying to go 50% back in. Okay? Very, very careful. So like I explained to you today, you just confirmed why this is that you should know it. See, if you would have known that, those people would have got you in that office to get your business hurt. See, if I was somebody, I wouldn't even put you in office. How long did it take me to explain this? Like 2 minutes? 2 minutes? But they had you get paperwork, they had you, sell you the dream of home ownership without even saying, hey, before we can talk about the dream, I want to help you get the dream. Let's talk about the numbers first. So once we get the reality first, now that'll help you get your dream quicker, because now you'll see what you got to do. And if that person was a real finance person, they can say, okay, yeah, the car or this or that debt is having you over what we are comfortable with lending you. So let me come up with a plan so how you can pay that off in the next few months, and then you pay that all off. Then you come back to me, or I'll check in with you in 5 or 6 months. Then we'll get your paperwork started. See, that's what they should have did. I'm that kind of financial coach and lender that I would do that, because it takes me nothing to be intelligent about how to help you get out of your financial situation so you can get into the next thing that you want to do in your life. That's all. So, and I'm not putting any bad mouth on anybody, but it's just that, I'm good at what I do, and I'm proud to say so. And I help a lot of people with these type of issues. But like I said, if you want more detail on that, get with me. I have no problem with helping you at all. We actually teach 2 times a week on how folks can get rid of their debt or manage their debt a lot more efficiently. So, maybe I'll remember to invite you tonight about that information. If you want that, let me know and I'll get you invited to that. But if there's no other questions, I'm going to go ahead and sign off. Any other questions? Anybody going once? This is your time. Twice? I'm about to down. Once again, thanks again. I appreciate you allowing me to come and be your teacher for the day. God bless you guys, ladies, children, all throughout my country. I love you guys. You keep supporting me, I'll keep supporting you. You guys have a good afternoon. See you later.